The American economy is no stranger to chaos. But this time feels different. Interest rates are soaring. Seriously, have you seen mortgage rates lately? It's getting brutal out there. Layoffs are creeping in and it seems like every day another tech company is handing out pink slips. And the markets? Let's just say they haven't been this red since Bitcoin's last existential crisis. So, what's happening right now in 2025? Is this just another dip in the roller coaster ride of capitalism, or could this crash rival, or even surpass, the 2008 financial crisis? That's what we're going to dive deep into today, because understanding the forces at play is the first step to protecting yourself and coming out ahead. We're going to break down the warning signs, the contributing factors, and the potential outcomes. I'll give you the no BS analysis you need to navigate this turbulent market. But first, to understand where we're going, we need to look back. Buckle up because we're about to take a crash course, pun intended, in economic history. Let's face it, the market can be a fickle beast, unpredictable and often surprising. One minute it's a bull charging ahead with unstoppable force, the next it's a bear ready to hibernate for the winter, dragging the market down with it. And throughout history, we've seen this pattern play out time and time again, a cycle of highs and lows. From the Great Depression of 1929, which wiped out savings and reshaped the global economic order, leaving a lasting impact, to the dot-com bubble bursting in the early 2000s, where tech stocks went from heroes to zeros practically overnight, causing widespread panic, the American market has experienced its fair share of booms and busts, each with its own unique story. And of course, who could forget the 2008 financial crisis, a time of unprecedented turmoil. The housing bubble popped, banks crumbled, and millions lost their homes and livelihoods, a stark reality for many. It was a stark reminder that even in the 21st century, economic instability is a very real threat, always lurking. But here's the thing. After each of these crashes, the market eventually recovered, showing resilience. After the 2008 crash, for example, it took the S&P 500 roughly 4 years to climb back to its pre-crisis high, a slow but steady climb. 4 long years of uncertainty and volatility, but ultimately the market found its footing again, proving its resilience. But each recovery has followed a similar pattern. Intervention from the Federal Reserve, government stimulus packages, and a gradual return of investor confidence, a tried and tested formula. The million-dollar question is, will that same playbook work in 2025? Only time will tell. Now you might be thinking, how does the market even recover from something like this? It's a valid question, especially when everything seems so uncertain. Well, it's not magic, although it sometimes feels that way. The process is intricate and involves multiple moving parts. It's a combination of factors, each playing a crucial role in the recovery. First, you have the Federal Reserve, the big dog of the financial system, stepping in to try and stabilize things. They are often the first responders in a financial crisis. They might lower interest rates to encourage borrowing and spending, or they might pump money into the economy through quantitative easing. These actions are designed to make money more accessible. It's like giving the economy a much-needed shot of espresso, jolting it awake. Then you have the government stepping in with stimulus packages like tax breaks or infrastructure spending, to try and boost demand and create jobs. These measures aim to get people back to work and money flowing again. Think of it as a financial defibrillator, shocking the economy back to life. It's a critical intervention. And finally, and perhaps most importantly, you need investor confidence to return. Without it, the market can't sustain its recovery. When people believe that the worst is over and that the market is poised for growth, they start investing again. This renewed optimism is crucial. This influx of capital is like fuel for the economic engine, driving prices higher and creating a self-fulfilling prophecy of recovery. It's a cycle that feeds on itself. But here's the catch. The speed and strength of each recovery depend on a complex interplay of factors. It's not always straightforward. How severe was the initial crash? The deeper the fall, the harder the climb back up. How effective are the government's responses? Their actions can make or break the recovery. And how much trust do people have in the system? Trust is the glue that holds the market together. So, the big question on everyone's minds is this: are we looking at a repeat of 2008, or is this something entirely different? Well, there are certainly some parallels. We've got rising interest rates, a shaky housing market, and a whole lot of uncertainty in the air. But there are also some key differences. The economy is more diversified now, and the banking system is, at least on paper, more resilient. However, we've got some new challenges to contend with this time around, like sky-high inflation, geopolitical instability, and a global pandemic hangover that just won't quit. Plus, the Fed's toolkit might be less effective this time around. They've already used up a lot of their ammo trying to prop up the economy during the pandemic, and their ability to raise interest rates further is limited by the risk of triggering a full-blown recession. So while we can learn from the past, we can't simply rely on old playbooks to navigate the current crisis. This is uncharted territory. We need to be adaptable, informed, and prepared to adjust our strategies as the situation evolves. And that's what we're going to talk about next. Alright, let's cut to the chase. Why is the market in free fall right now? Well, it's not just one thing, it's a perfect storm of factors that have been brewing for a while. First off, inflation. Remember when everyone was complaining about avocado toast prices? Yeah, those were the good old days. Inflation hit a 40-year high in 2022, and it's been like a game of whack-a-mole ever since, with prices for everything from gas to groceries to rent going through the roof. This wasn't caused by people suddenly developing expensive taste in toast, though. It was a combination of factors like supply chain disruptions, increased demand as the economy reopened after the pandemic lockdowns, and, let's be honest, some good old-fashioned corporate greed. And how did the Federal Reserve respond to this inflationary pressure? By slamming on the brakes with aggressive interest rate hikes throughout 2023 and 2024. Now, in theory, this was supposed to cool down the economy and bring inflation under control, but in reality, it's had some pretty nasty side effects. Businesses are getting squeezed by higher borrowing costs. Consumers are cutting back on spending because their credit card debt is crippling, and the stock market is freaking out because, well, uncertainty is never good for business. The ripple effects are being felt across the globe, making it a truly perfect storm. So we've got inflation and rising interest rates. Sounds fun, right? Well, hold on, because it gets even better. Remember those layoffs I mentioned earlier? Yeah, they're not just happening in the tech sector anymore. As businesses grapple with shrinking profit margins and economic uncertainty, they're starting to trim the fat, and unfortunately, that often means people lose their jobs. This creates a domino effect. Fewer people with jobs means less consumer spending, which means businesses make even less money, which means even more layoffs. It's a vicious cycle, and it's not pretty. And as if all of that wasn't enough, we've also got some geopolitical tensions adding fuel to the fire. Remember that trade war with China that everyone thought was over? Yeah, it's back on, and this time it's not just about tariffs on soybeans and steel. We're talking about restrictions on crucial technologies like semiconductors and artificial intelligence chips, which are essential for everything from smartphones to self-driving cars. Now you might be thinking, I'm not invested in Chinese tech companies, so why should I care about a trade war? Well, here's the thing. In today's interconnected world, what happens in one part of the globe inevitably ripples out and affects everyone. This trade war is already disrupting global supply chains, driving up prices for consumers, and creating a climate of uncertainty that's making investors hit the panic button. And it's not just China. We're seeing geopolitical conflicts and economic instability popping up all over the place. The war in Ukraine has sent shockwaves through energy markets, leading to higher prices at the pump and increased volatility. Political turmoil in some emerging markets is making investors nervous about putting their money there. It's a perfect storm of global challenges, and it's creating a level of economic uncertainty that we haven't seen in decades. And that, my friends, is why the market is crashing. But don't worry, it's not all doom and gloom. In the next chapter, we're going to talk about what this means for you, and how you can protect your finances during these turbulent times. Now, let's unpack this trade war with China a bit further because, frankly, it's a major player in this whole market mess. Remember when the US and China slapped tariffs on billions of dollars worth of each other's goods back in, what was it, 2018? Yeah, well, that was just the opening act. Fast forward to 2024 and things have escalated. We're talking about new tariffs on key industries like semiconductors, those little chips that power everything from our smartphones to our cars. The administration argues that these tariffs are crucial to protecting American intellectual property and preventing China from gaining a technological edge. But here's the thing. This strategy comes with a hefty price tag. And guess who's footing the bill? That's right, it's us, the consumers. Those shiny new iPhones we all love, they're about to get a whole lot pricier thanks to these tariffs. Now, I'm as patriotic as the next guy, but this whole protectionist approach to trade just doesn't make economic sense. It's like trying to put out a fire with gasoline. It might seem like a good idea at first, but it's only going to make things worse in the long run. Remember what economist Paul Krugman said, protectionism always feels good at first, until consumers start paying the price. Truer words have never been spoken. When we erect barriers to trade, we disrupt the natural flow of goods and services, leading to higher prices and fewer choices for everyone. And it's not just consumers who suffer. Businesses, especially those that rely on global supply chains, are getting squeezed from both ends. They're facing higher costs for imported materials and components, and they're also dealing with decreased demand as consumers tighten their belts in response to rising prices. A global chain reaction. But here's the kicker, this trade war isn't just hurting the US and China, it's sending shockwaves throughout the global economy. When two of the world's largest economies start throwing punches, everyone feels the pain. Countries that rely on exports to the US or China are seeing their economies take a hit as demand dries up. And because everything is interconnected in this globalized world, the ripple effects are being felt far and wide, further fueling uncertainty and volatility in the markets. So what's the solution? Well, it's complicated, but one thing's for sure, slapping tariffs on everything that moves isn't the answer. We need to find a way to work with our global partners to create a more open and rules-based trading system, one that benefits everyone, not just a select few. Alright, let's cut to the chase. What does this whole economic roller coaster ride mean for you, the average investor, especially if you're a millennial like me? Well, I'm not going to sugarcoat it. Things are looking a little dicey right now. Remember that 401k you've been diligently contributing to? Yeah, buckle up because it's in for a bumpy ride. The stock market is volatile and your retirement savings are feeling the heat. And don't even get me started on the housing market. Remember those crazy low interest rates that made buying a home seem almost attainable? Those days are long gone. Interest rates are climbing, making mortgages more expensive, and pushing homeownership further out of reach for many millennials. But hey, at least rent is still affordable, right? Wrong. Remember that whole inflation thing we talked about? Yeah, it's still wreaking havoc on our wallets, and landlords are feeling the pressure too. They're dealing with higher property taxes, increased maintenance costs, and of course, those pesky rising interest rates. So guess what? They're passing those costs along to you in the form of rent hikes. And it's not just housing that's becoming unaffordable. Groceries, gas, utilities, you name it, it's costing more. This relentless rise in the cost of living is putting a serious strain on millennials, many of whom are already saddled with student loan debt and stagnant wages. Finding opportunity in chaos. Now I know this all sounds pretty bleak, but before you go full-on doomsday prepper, hear me out. There's a silver lining to every cloud, and this market crash, while painful, presents a unique opportunity, especially for young investors. Remember what Warren Buffett famously said? Be fearful when others are greedy, and greedy when others are fearful. Right now, fear is running rampant in the market, and that fear is creating some incredible buying opportunities. Stocks are on sale, my friends. And if you're in it for the long haul, this could be your chance to snag some undervalued assets and set yourself up for future financial success. Remember, history has shown us time and time again that the stock market always recovers. This time is no different. Okay, so we've established that things are messy right now, but the million-dollar question is, when will we see the light at the end of the tunnel? Well, the experts are split. On one hand, you've got Goldman Sachs painting a cautiously optimistic picture. They're projecting a slow and steady U-shaped recovery, with things potentially stabilizing by late 2026. Their prediction hinges on the idea that the Fed will ease up on interest rate hikes as inflation cools down, and that new tech, especially in AI and renewable energy, will drive growth. Basically, they're betting on innovation and a more balanced economic approach. But then you've got Morgan Stanley sounding the alarm bells. They're worried about the mountain of consumer debt we've racked up over the past few years. Remember all those credit card balances and student loans? Yeah, those could come back to bite us. Morgan Stanley argues that this debt burden could significantly delay any meaningful recovery, potentially pushing it out by years. Now, I'm not gonna lie, this debt situation is a big deal. When people are drowning in debt, they're not spending money. And when consumers aren't spending, businesses suffer, the economy slows down, and it becomes a vicious cycle. Think about it. If you're already struggling to make ends meet, are you going to be out there buying a new car or investing in the stock market? Probably not. You're going to be focused on paying off those high-interest debts and making sure you can keep a roof over your head. This is why Morgan Stanley's warning is worth paying attention to. If consumer spending remains depressed for a prolonged period, it could throw a wrench in even the most optimistic recovery scenarios. The bottom line is this: the speed and strength of our recovery depend heavily on how quickly we can address this consumer debt crisis. If we can find ways to alleviate that burden, whether it's through policy changes, debt forgiveness programs, or something else entirely, it'll go a long way in setting the stage for a brighter economic future. So with all this uncertainty swirling around, what can you do? First off, don't panic. Remember, market crashes are a natural part of the economic cycle. What goes down must come up eventually. The key is to be prepared and to use this time to your advantage. That means shoring up your emergency fund so you've got a cushion to fall back on if things get tough. It also means being smart with your investments. Now is not the time to be chasing risky bets. Instead, focus on building a diversified portfolio of solid companies with strong fundamentals. And listen, if you're feeling overwhelmed or unsure about what steps to take, don't hesitate to reach out to a financial advisor. Having a professional in your corner can make all the difference in navigating these choppy waters. Remember, knowledge is power. The more you understand about the market and the factors driving it, the better equipped you'll be to make informed decisions that protect and grow your wealth. Let's be real, this 2025 crash is a big deal. We're seeing a confluence of factors that we haven't seen in decades: runaway inflation, aggressive interest rate hikes, geopolitical instability, and a whole lot of uncertainty about the future. It's natural to feel anxious, even scared, but here's the thing. Letting fear paralyze you is the worst thing you can do right now. Remember, every crisis presents an opportunity. The key is to stay informed, stay calm, and focus on the things you can control. You can't control the Fed's decisions, you can't single-handedly solve the global supply chain crisis, but you can control how you react, how you manage your money, and how you position yourself for the eventual recovery. And trust me, a recovery will come, it always does. Here's the good news. History has shown time and time again that the biggest winners in the market are often those who have the courage to invest during times of uncertainty. When everyone else is panicking and selling low, they're buying low and setting themselves up for massive gains down the road. Now, I'm not saying you should go all in on the stock market tomorrow. Investing always carries risk, and you should never invest more than you can afford to lose. But I am saying that this crash, like all crashes before it, will eventually pass. And when it does, those who stayed the course, kept a cool head, and continued to invest wisely will be the ones reaping the rewards. Remember, time in the market beats timing the market. So, what are your thoughts on the 2025 crash? Are you feeling optimistic about the future, or are you more cautious? Let me know in the comments below. I read every single one and I'd love to hear your perspective. And while you're down there, hit that like button if you found this breakdown helpful. It really helps the channel grow and allows me to keep creating informative content like this for you. And most importantly, don't forget to subscribe and hit that notification bell so you don't miss out on future videos where we'll continue to break down complex financial topics and empower you to make smarter decisions with your money. Remember, knowledge is power, and together we can navigate even the most turbulent of financial times.